Hello and welcome. Today we're going to go through everything related to pensions and to see if we can unbox and try not to confuse things too much and hopefully have a little bit of clarity in some situations that you may not understand or may understand around pensions and hopefully pad that out a little bit. So some key areas that we'll highlight along the way. So first thing we'll do is just summarize topic at hand. So we'll go through what a pension is, the fact that it's sort of tax wrapper investment vehicle, and I'll cover those in more detail. Why choose a pension? What types of pensions are there, and how do they differ? Potential cons of a pension as well, just to be unbiased. And then what are the other ways in which you could potentially retire, or other kinds of products and things that you might be able to utilize to facilitate that. It's not going to be a particular sort of discussion around retirement planning, because I'll do a separate one on that. This one's specifically around the product of a pension. So what is a pension? So essentially it's a form of tax wrapper. So a tax wrapper, the way I try and describe it, is you've got different investments, you've got different assets that you can hold, but ultimately it's a way to wrap that particular asset or investment without having to pay tax on it. So you put a wrapper of tax around it, essentially. How this can sort of benefit you in the long term. It's essentially a tool to save money in, so it's tailored and used towards your retirement, albeit you don't have to use it for regular income and different things, and I'll touch on that a little bit later. But what it is tailor-made for a retirement, so that's what it's there for. Can be a personal arrangement, or you can get it through an employer, like an occupational scheme. I'll touch on a bit about final salary schemes and things as well, and how they compare. And also, having a personal pension can build independence, so there's less reliance on the state, because the state pension, albeit is great and we're sort of lucky to have it, is something that's getting pushed further back. And the reason why is because it's only designed to cover a third of an adult's working life. So with that only covering a third, it's quite important to make sure that you get your own provisions, so when you look to retire, it can either be sooner, or you can live the retirement that you plan to want to, and not having to sort of scrape pennies together and sort of rumble through, just getting by, really. And a few ways that we can you can do that is through a pension, because of the certain tax breaks that they can facilitate. So a couple of misconceptions around what your pension may be. I've put a slide up here that you'll see, which is a couple of different what we call in the industry platforms, or you might know them as providers. Some that you might recognize, some that you might not. A misconception of your pension is that it's essentially, most people I speak to will say, oh, my pension, Pete, is with Aviva. Now, that's right to some degree. It's with Aviva, but what are the assets that are within that pension that you've got with Aviva or Royal London or whoever it is? Because it's not actually a case of that your pension's just held with Aviva. You will have assets that are kind of within that. And again, I'll touch on this a bit more in a second. So let's just go on to what I mean by this. So if you were to, in the picture that I've got in front of me there, is a tin, essentially, or a can. If you were to peel open that can and look inside, and the can is your pension, so Aviva, you could imagine on there, or Royal London, or whoever, Nest. Open it up, and then inside, if you were to peer in, you would see funds, or different types of fund structures, or, there's managed portfolios, there's different types of structures that you could build in there, without going into the more complicated side of what types of investments, because again, I'll do a separate live for that. But this one is very much, you open it up, and then what is your actual pension invested in? Because it's not just my money is held with Aviva. Yes, they are like the shop front almost, but what are the products within the shop that you have? So it's important to know what they are, and how do they sort of compare really with what you're comfortable with, what you expect to be invested in. Some people might not want to invest in certain things. I've got clients that don't want to invest in like armament and tobacco trade and certain things like that. And then I've got other clients that I just want the most optimal returns, and we can look at sort of everything really. So that's one side of thinking. The other side is it actually performing the way that you would expect it to? If you looked at your pension, because most people don't, and why would you? Because again, it's something that we don't really get taught. If you were to look at the past performance of your pension, has it performed in a kind of slightly more linear progression, or has it been more volatile and it's gone up and down? And how is this? Are you comfortable with the way that has performed long term? Is it something that's gone up, it's gone down, but you know how it is? And if you were to look back, has it done what you essentially wanted it to do? And if not, well, perhaps tweaking. You don't have to move your whole pension provider if you don't want to, but tweaking the funds within and kind of fine tuning can then mean it can perform the way that you perhaps want it to, or even achieve the goals of your retirement or whatever you're looking to do with your particular pension pot. So something to think about. Other thing to think about is, for you as a person, what are you invested in? So just check it. It's quite straightforward to find out. Understanding it, granted, might take a little bit more know-how to understand what that is, but you can find out either on statements that you get from your pension provider, or even call up and ask and try and find out, well, what are you sort of invested in, and is this correct for you? So it's quite an easy one to find out. You can just either contact your pension provider, or a financial advisor can do this for you, where they'll request a letter of authority. You'll sign it on their behalf, so they've got authority to request that information, send it off to the pension provider, and they'll do the chasing. Then when that comes back, they'll be able to sit down and have a look in all the fine print and look at all the details, to then be able to relay that back to you and say, this is what your pension's, who's it's with, and this is what you're invested in, and this is what it's done. Shall we look to change it, or are you happy with as it is? So what are the types of pension? I've kind of done it to the highest possible level that I could, and then we kind of like trickle it down from there. So you have a defined benefit, or what some people know it as a final salary, and you also get a defined contribution. DB or DC essentially is the lingo that we kind of use in the industry. But a DB, or defined benefit final salary, are quite few and far between now. They're quite rare in the conventional sense. Years ago, it was quite common to have one. Now it's less and less common, because they're quite expensive to run, and they're quite expensive to actually maintain. And I'll explain how they work in a moment. But that, compared to defined contribution, is more what your conventional or modern day auto enrollment looks like as well. So if you think defined benefit, you think in military, fire, police, NHS, big corporate organizations that can afford to still have these, or if you've got some old type of legacy pension that you can keep paying into, compared to a defined contribution, which are still, they've been around a really long time, but they are more relevant and more pertinent now, and in today's world, since auto enrollment came in and really sort of started ramping up at about 2012ish. So what the differences fundamentally are is, a defined benefit is a promise or a benefit. So a promise to benefit from a pension. It's essentially one big pension pot. So if you had a military pension or an NHS pension as an example, or even a big corporate pension, that will be one giant pot of money that company will hold, that you have a promise later on in life to be able to take a small section of that pension, as firstly as a lump sum up front of 25% tax free, in most cases called commutation or commuting your pension, and the remaining 75% will then be used to give you a regular income. Now, that regular income, as a rule, will be for the rest of your life, and then you can have certain benefits and tweaks relating to this, such as a widow's pension. So if you used to pass away, 50% of your regular income that you receive will pass to your partner, or whoever you nominate will pass 50% to them, and then that might pay out for another 5 or 10 years, depending on the way the scheme is set up, and each pension provider is different, or defined benefit provider is different. Also, the way in which they are structured differently is not just the fact that it's one big pension pot and you get the regular income. It's also a little bit more limited on what you can do with it, because you can't really say, if you took your lump sum and you start taking a regular income, you can't say, I want to take more this month, I want to take less that month, because I want to leave it and preserve it. It's just very much, once it starts, much like your state pension, it just pays out and you keep getting regular income. So it's great for stability, and they can form a great foundation to retirement planning. But also, if you're wanting to flex your retirement and think, well, I'm kind of a bit younger in retirement now, want to do more things, so you perhaps want to spend more up front, or you're thinking, well, actually, I've got this money here, I want to do something with, you're a bit more limited in being able to take chunks and have that kind of flexibility as a comparison. It's also quite complicated to get the actual value of what it is, because you don't have a pot of money yourself and you have a promise to have a regular income based on your final salary or based on average years of service, and that's how they get calculated, years of service, or an average years of service, and what your final salary is at the time. There's different ways. I'm not going to go into it now because they're very complicated to calculate, and even though they're a complicated scheme, the fundamentals of when you have one are quite simple, because you can take 25% or you don't, and all that does is like a sliding scale. The more of your tax-free cash, the 25% you take, then the less income you'll receive on a monthly basis. Or if you didn't take any of the tax-free, you can then receive a bigger amount per month for the rest of your life. And once you receive it, that's it. You start receiving it and it's regular. Like, it doesn't change. Sometimes there might be index linked, which means they'll go up, or they'll, with inflation, just so that the purchasing power of the money maintains as goods and services go up. But other than that, they're fairly straightforward. And for a lot of people, if you've got one, it's a case of you don't really need to do much with it, because you don't have much choice to do anything with it. You can't change investments. You can't really stipulate that you want less or more money. So once you claim it, it pays out, and the fairly straightforward. The complicated part is if you ever did want to try and transfer one of these pensions, because the way in which they calculate them when you request a cash equivalent transfer value is quite a complicated formula. Once you figure that out and you know what that's worth, then that can then be looked to move, and then you will then get you'll get a lump sum of your own money into a different pension pot that you can decide what you want to do. But it may be that that's not the right thing. For a lot of people, it's not. There's only certain circumstances where it's worth really transferring out of these, and that could be because you've got very short life expectancy, and you think, well, having a regular amount's great, but if you're not going to live that long, or you think you've got a shorter lifespan because of some hereditary thing or anything like that, and you might want the money now to spend, then it can be a sort of a valid reason to potentially transfer out. And there's a few others as well, but I'm not going to go into massive details, because for a lot of people, if they've got one, the first instance is great. This is what it is. This is what it does. But we just leave it where it is. We don't need to transfer it, don't need to move it. So I'm not really going to go down rabbit hole much more on final salary or defined benefit pensions. The rest of the pension related conversation in this will really be more around the defined contribution, because they're a little bit more complicated, and more people are having these, and they're more common now than the defined benefit. So leads into what is a defined contribution. So there's no guarantee in this. So the reverse, really, or the flip side, is that there's no guarantee it will last. You still get a 25% tax-free lump sum. I've also put there that triggers a thing called the MPAA, money purchase annual allowance. So when you start taking money from your pension, and it has to be any taxable amount of money, so anything over your 25% essentially that's tax-free, even a penny over, triggers a thing called the MPAA, money purchase annual allowance, and does restrict future contributions, which a lot of people aren't aware. So if they're taking big chunks out of the pension, and then they go, actually at later date, want to put them back in or pay into it to invest, because pensions are a great vehicle to do that, there is quite a big limitation on it as well. I'll talk about this more in the retirement planning part, that I'll do a separate live on. So flexible choice with more but requires more involvement. So you get more flexibility. You can take it as a regular income. You can take your 25% tax free, or you don't have to take that. You can take segments. So you could take a segment of your pension, which of that segment or that slice that you would take, 25% is tax free and 75% of that chunk is taxable. And then you can start being clever with personal allowances when you retire, if you're no longer earning money, to actually draw out quite a bit of your pension in a very sort of clever way, really. So they're a bit more complicated in that the actual running of them is more a hands-on approach, which is where most people start to see the value of advice come in, especially when they get to drawing pensions down and trying to understand, well, is it going to last, Pete? What's it going to do? How long's, who's going to get it? All these other things are questions that come up frequently when I speak to clients, and why I've gone more into detail on these. And because more people have these as a result of auto enrollment now, unless you've chosen to opt out, you will start building up maybe multiple pots. And because people are moving jobs more often as well than kind of ever really, because of that, people are having lots of little pots around. So pulling them together can be an option, but ultimately, once you've got your defined contribution pot, it just requires a bit more hands-on approach for you to figure out what you want to do with it, really. So what are the types of defined contribution? So we've kind of created a bit of a fork in the road, really. We've gone defined benefit, defined contribution, and then we've gone more down into forking the defined contribution. There is some avenues that you could go down with defined benefit, but again, they're fairly more straightforward in what they are, and it's more down to the limitations of what that type of scheme is. So with defined contribution that we're at now, you've got a few different types. You've got a group personal pension scheme, which is essentially a group of individual pension pots kind of put together, essentially. So if you imagine there's 10 employees, they all have their own pension pot, but they're all under just one plan, essentially. So you all have your own value of money and your own pot that you build up, but they're all sort of lumped together for ease of admin. That's a very, very simple way of thinking about it. You've got they're called a SAS, or a small self-administrated pension. These are essentially more flexible, and you can still have a grouped individual pensions, but what you can also have is a pooled type investment, so that you all put your money into one pot and then you draw it from there. So they're more flexible. There's certain quirks that you can use. They're a little bit more complicated, and they're usually it kind of goes up to about 11 employees or so of a company that you'd have these. If you start going more, then you're looking at other types of schemes. So the top two are more group related ones, or potential occupational related personal defined contribution pensions, whereas the other three that I've listed are more individual as opposed to more company related. So the stakeholder pension, which is the top one that you see, that is kind of a low cost. It's actually before auto enrollment came in that there was a stakeholder that was there first. So it's been around a long time. There's limitations on charges, which are very low charging, but as a result of the low charging, certain funds and investments can't go in them. So yes, they don't cost a great deal to have, and they're fairly basic and straightforward, probably the most basic and straightforward. But as a result of that, you are limited on the type of investments that you can go into. Then you've got a personal pension, which is what most people think about when they just think about a pension, and this sometimes gets a bit of a grey area or an overlap with a self-invested personal pension, because some providers call just a personal pension and have a separate offering, and some will call it a self-invested personal pension. The main difference is personal pension means you invest money, you build up your own pot alongside any work type schemes or anything like that. You just build up your own pot of money, and you've got quite free reign to invest in the things that you want to with a platform of your choosing. Whereas a self-invested personal pension, for some providers, has an even more scope. So they can essentially just have certain types of investments. You can even hold commercial property in a self-invested personal pension, which you can't with any of the others, other than a self-administered. You can potentially look to do that with that. But a self-invested personal pension has more options, but the costs are slightly more. So the way that I've done it is stakeholder personal pension and self-invested personal pension is more kind of in a lower cost, mid-range, slightly higher cost, but with the restriction on accessibility of investments increasing as you get, you're potentially willing to pay for more of those things. So they're the different types of investments that you could, or types of pensions, sorry, that you could hold. And just going on to something else, which is a pension that people forget about, and I've touched on it already, is your state pension. Again, it underpins a massive foundation for a lot of people of their retirement. And it covers a big chunk of paying for bills and things. And once you get to retirement, if you're looking to have your mortgage paid off and a few other things to sort of streamline your outgoings, if you've planned it to be that way, then this can cover a lot of the basics, which then means your own personal plans, whatever that may be, or even other work plans that you've converted into personal plans or however, that can be then your a bit more fun money then. So you're covering your foundations, but then you've got extra money on top to be able to do the things with what you want, because state pension isn't really designed to cover kind of not so much a lavish life or a really prosperous one. It's more just to cover a basic amount, and it's only designed to cover a third of adults' working life, like I mentioned at the start. So having your own provisions massively improves, and the more that you're willing to put aside for that to have that retirement, the more that can then project for your planning. So check your state pension. You can do this on the government website, and I'll put a link in the description for it. But you can put in what your forecast is. There's one which you can put when it is, because some people it's 67, some people it's 68, depending on your date of birth. So you can put your date of birth in, and it'll tell you that. And there is one which essentially tells you your individual forecast. So there's a couple of ways you can do it. You can either call them to find out over the phone. You'll just need your national insurance number for it. You can use a form that you fill in and fill it in, and it's quite a laborious process, to be honest, if you do it this way, but you can fill it in, send it off, and they will then post that back with all the information. Or if you can log into your government gateway, which is the quickest way and the most instant way to find out, really, log into your government gateway, put in your details, and it'll tell you two different figures. It'll tell you what your state pension is forecasted to be if you paid all of your full credits, which is 35 years, pay your full credits into it. What will that be? Which is usually the big number. But the one you want to look at is usually the one underneath. And the one underneath is actually what you would get as of now if you didn't pay any more into it. So you can then figure out what the shortfall, if you're not going to receive your full state pension credits, to be able to do that. And you accumulate state pension credits by paying national insurance, or if you're on certain types of benefits as well, you can accumulate it that way. Or if you pay, reach basically as a minimum threshold that you have to pay into the system, that then you'll receive those benefits or those credits that build up towards your state pension. So checking it is quite important, because it's something that a lot of people forget about, and it can be a bit of a game changer, really, and also give you a good solid foundation. So when to, or why to choose a pension over potential other options, or why to even consider a pension at all? Well, there's nothing else like it, really. Yes, you've got ISAs, and you've got other different types of other tax wrappers, like I mentioned earlier, that you can use to save into. But the way in which a pension works is that you get instant tax relief when you make a contribution into it. So for a basic rate taxpayer, you get a 20%. You get essentially your 20% tax that you've paid as a basic rate taxpayer on that money. You essentially get that back. So any money you put in to your pension, you will get that 20% back straight away. It's pretty much automatic, essentially. Well, there's a couple of ways it can be done, which I'll explain in a moment. And if you're a higher rate or an additional rate, you can either get 40 or 45% back as well. And I'll explain that just now. So basic rate taxpayer, if you put, like 80%, I've done it there as a percentage, but if you imagine that being £80 as well, as a basic rate taxpayer, you're getting £20 straight away that goes into your pension. As a higher rate, example 60, but you're getting 20 plus an additional 20. So for higher rate and additional rate, it can be even more powerful to do so if you're employed. And then 55, 25, and 20 as well. So you'll see the way that works as an additional rate. So that's quite a very powerful tool to get the money up front, because being that it's up front, it means that it has a chance to compound a lot quicker, to build up your pot straight away. And there's really nothing else that you could say, I'm going to put money into to the volume that you can put into a pension, because granted, certain lifetime ISAs and or pretty much lifetime ISAs that you get bonuses on and things, you can get bonuses up front, but you can't get 40% or 45% back. If you was an additional rate, you're still limited with other types of wrappers. So there's literally nothing else like it, and the contributions that you can put into this are significantly more than other types of products, let's say. So automatic tax relief, that works on there's a couple of different ways that you can get it automatically. So your employer takes a workplace pension contribution out of your pay before deducting income tax, or your pension provider claims tax relief from the government as a basic rate and adds it to your pension pot, sort of relief at source. So there's a couple of different ways that can happen. Somebody's employed. Now, if you're need to claim more, which you can do if you're a additional or higher rate, then the way in which you have to do this, which catches so many people out, and it's something that I've even spoke to clients within the past that weren't aware of it, and I've mentioned it to them, and they've got a small fortune back. And it's, if you're a higher rate or additional rate, you're entitled to an extra 20 or 25% tax back, but you have to do it yourself. It's not automatic. Like if you're a basic rate taxpayer, it just goes in straight away. If you're additional or higher rate, you do it through either self-assessment, tax return, which is the way to do it, or you can also call up if you're just paying 40%, but if you're paying 45%, so an additional rate, then you'll have to do it through self-assessment anyway. But that can be a massive game changer as far as the money you're getting back, because it's your money anyway, and that's the way the pension's set up and the way that the rules and legislation are set up. It's just that you've got to physically claim that, and you can claim back for about 3 years worth. So if you've not done it and you are a high rate taxpayer and you're thinking, am I getting the extra bit that I've done in? Because an employer will automatically pay the 20% in for you, or so the government will pay into that, and the tax relief will be there, like the relief at source and things I've already mentioned. But if you're not aware of not being told, you're actually eligible for more. So, getting on to filling that in, or even doing a self-assessment tax return to claim that, and then backdating it. You might need help with an accountant to do it. Backdating it for 3 years to claim what's money you're due, essentially, can be a massive winner. Other benefits of a pension scheme is that it's tax-free growth. So not only do you get the contribution when you make a contribution in, you get the relief up, so you get the tax back, or it's called getting grossed up, essentially. You also get tax-free growth. So the money that is in there, whether it's the extra relief you've got in, or contributions you've made, or just the dividends of interest that's built up from the certain types of funds that you've got in your pension, it's all tax-free growth. So if you had an absolutely, wild amount of returns, it's all tax-free growth, which is just, brilliant to get in itself. So no capital gains or anything to pay on it. There's also, just as a little bonus one, really, while I'm on it, there is also no inheritance tax to pay on a pension, which is also a massive winner, because you don't pay. It doesn't form part of your estate if you've nominated somebody in your pension, and I'll touch on that now. So, who gets the pension if you were to pass away? So, if you nominate a beneficiary, so you either fill in what's known as a death benefit nomination form or an expression of wishes form. They're actually the same thing, but some providers call them different things, just to keep it really simple. You nominate who that might be. So it could be children, spouse, whoever, or both. I usually tell clients, do the majority or all of it. Say if you had a wife or a partner and had one child, you would put 99% to the wife or the partner, and you would put 1% to your son, daughter, child, for example. Reason being, then if something happened to your other half, your partner, then the next person that's listed on there would actually receive all of that, receive that pension instead. Because if you don't nominate that, what can happen then is it then can get paid out as a lump sum into the estate if somebody passes away. And if it forms part of the estate, it can then start getting more complicated around taxes and everything else. So if you want to avoid that, keeping it within the pension wrapper is the best way, and you can essentially pass the whole pension over to somebody else who's either a successor pension, it's called, or a dependents pension. And the couple of rules around this is if that person inherits that pension, if the person that passed away was before the age of 75 when they passed away and the pension came to you or to whoever, all of that pension is tax-free. So you could take it out all in one lump sum. You could take out segments. You could do what you needed to. If it's after the age of 75, it then becomes a potential taxable tax liability that you have to pay based on your individual circumstance. So if you're a basic rate taxpayer, you'll have to pay basic rate tax on that pension. So that's just the rule of 75 potentially if there's before or after. Again, that's where sometimes advice comes in for certain clients that it gets a bit more complicated to work it out. So yeah, look, like I've already in that sort of little caption at the top there, I've got you can do a lump sum, purchase annuity as a nominee or successor flexi access drawdown. So that's what happens to it. This is again related to defined contribution pension. So like your auto enrollments or your personal pensions, a defined benefit that I mentioned earlier is slightly different because they wouldn't inherit a pension pot like they would now in this type of pension or defined contribution. They would just inherit essentially some of the benefits, usually not all of them. It's usually 50% of the regular income that you might receive for a set amount of time. So they're quite different in the way that they're structured. Right. So going on to auto enrollment. So firstly, check who you're with. So you may be with Nest, you may be with Aviva, Royal London, Legal and General, People's Pension. There's plenty of different auto enrollment schemes. The most lowest cost and straightforward that most employers put you into because it's their minimum legal obligation is either a Nest or a People's Pension. So if you've got one that's a little bit more flashy than that and you've got like an Aviva one, then that's something that employer is elected to choose instead, as usually a rule of thumb. So check who you're with and check what you invested in. Also, will they match contributions towards a pension? Because this can be one that, again, is massively overlooked. And you might be thinking, why would I want to keep paying into my pension when I need the money sort of now, which I understand. But if you put in a little bit extra now and they're willing, they don't have to, but if your employer's, a large employer and has got the capability to be able to do that and they can match or even have some additional contributions that they can put in, that can be enormously beneficial because then it's essentially free money that you're getting. Sometimes they don't mind doing it because the more they put into a pension on your behalf, that's a tax deductible expense for them. Having staff myself, I can appreciate that now and start working through that and going, well, if you're putting money into a pension or you're paying tax on behalf of employees and things, they're all tax deductible expenses. So it's not all doom and gloom for the employer to put in more money as well. It can have some perks to it. We've also got, and the last one, sorry, just to jump back, was can you consolidate? If you've, as I mentioned earlier, got lots of pension pots everywhere, and again, I don't really know what to do with them, the administrative burden of it is stressing me out, which again is a lot of what I deal with clients for. They come to me and I go, I think I've got sort of 4 pension pots, or if I spoke to a married couple and I'm between them, I think the most I've ever came across is 14. Lots of pension pots, all different values, and they were like, I don't really know what to do with them, Pete. And I was like, right, first we have to check as advisors as a whole, is it worth pulling them together? Because some of the charges and the costs and things, so you calculate all that. And if it is it better to put them all into one that they've already got, to shift it into one? Or is it better to pick a new platform and move them all and consolidate them onto that one? There's a few things you have to kind of check to make sure that's worth doing. And weigh up all the cost charges, what you invested in, and performance and everything else. But if you can consolidate them, check that out. But the one thing I would say is, if you are looking to consolidate them and you're able to try and do this yourself, just check that by moving your workplace scheme, you don't lose out on the employer contribution, because then they're not obligated to pay on your behalf. So if you opted out of a Nest pension because you wanted to move it and invest somewhere yourself into like a self-invested personal pension, because you didn't like the way that Nest only has sort of about 6 different funds, whereas you could move it to somewhere else and you could have thousands to choose and to tailor it yourself. The thing you need to check there is if a move the employer is no longer obligated to pay into the auto enrollment pension. So you're losing essentially the free money that they're legally obligated to pay. So it's just a bit of a warning really on that one. So potential cons of a pension, just to try and be more, unbiased about it really. So few things around pensions themselves are limited access. So at the minute it's 55. That will be going up to the age of 57 for personal schemes. Again, this is more related to defined contribution ones that I'm talking about. Defined benefit can have certain rules. And if you've got quite an old legacy pension, there can be the situations where you have certain eligibility rights to potentially claim it sooner, or even be eligible for slightly higher tax-free cash. So again, just checking the fine print essentially. But limited access is a biggie. So if you're thinking, I want to make a pension contribution, but I don't really want to tie my money up for it, then there is potential other ways, like you can utilize ISA wrappers and things like that. Very different rules. But again, you've got more flexibility with that compared to a pension that's tied up. The benefit of being tied up, to flip that on its head, is that you're not going to then spend it. It's there for your retirement. So it kind of safeguards it as well. Got change of legislation or legislation change. If they were to change this at all, so if the Prime Minister was to turn around and go, right, we're changing pensions, or the Chancellor of Exchequer, we're going to change pension rules because of this, this, and this, there is that risk, much like anything, tax can change, rules can change, and anything. It's just something to be aware of, that they could limit certain pension things. They haven't yet. They've actually done quite the opposite as of late. They've increased those massively. But it's something that they could swap and change. The risk is there with a lot of things, but it's one to consider when we're talking about governments. Taxable withdrawals after your tax-free cash. So as I mentioned, yes, it's great you get the 25% tax-free cash, but then the remaining you start taking from a pension is taxable. So you get relief at source. So your pension gets contribute and your pension gets grossed up. So you get added tax relief in, which is brilliant. You also get tax relief, not tax relief, but you don't get the tax on the growth, so no capital gains. But then on the way out, when you actually claim on it, there is a tax liability to pay. But this is where you can start being clever. When you retire, it's unlikely that then you're retiring because you're going to continue working. So you're going to have lots of allowances and things that you can utilize to be able to make it more efficient. And if you were a high rate taxpayer, when you was building up your pension and getting 40% tax relief, and a non-rate taxpayer when you retire, well, then you're not really paying much tax on it if you don't need to have a lot of regular income in a way of calculating it. So yeah, that's more retirement planning. I'll talk about that in a separate live, but it's just one to be aware of, that it is a taxable element. So it takes a little bit more sort of know-how and planning. And then the last kind of one really is that they are complicated for most people. It's not something, again, you get taught. It's not something that you sit down and get excited about for a lot of people and really understand. But it is the benefits of a pension and how they can work, if you can wrap your head around it, are massive. But it is complicated to potentially understand. So that's another kind of pitfall of them, really. So what else can I do? So if it wasn't a pension, it wasn't a that you was going to be using, what else could you utilize instead of a pension? So a couple that I've listed here is we've got property income, so rental income as one that some people use, and I've got clients that use these as their retirement vehicle. So instead of a pension, they've got property. You've also got a lifetime mortgage. Now, caveat this one with, it needs extra consideration, but a lifetime mortgage is or an equity release mortgage is where you essentially pull money out of a property to utilize. So in some situations, instead of pulling money out of your pension because you want your tax-free amount to spend on something, whatever that may be, you could then look to do that out the property instead. And you might consider doing that, not to say it's right, but you might consider doing that, because leaving money in your pension is going to have the tax-free growth. It also means that if you were to pass away, you can pass that inheritance tax free to somebody else. Whereas if you was to take it from the pension, you're limiting that. Your property, on the flip side of it, your property is like taxable and things like that. So There's a few ways that you can sort of manipulate your whole situation depending. So that's one other kind of tool in the kit bag. Then you've got a LISA or a lifetime ISA, so a lifetime individual savings account is what that stands for. These are kind of usually used for first-time buyers if they're purchasing the first home, but you can use it towards your retirement planning, and you put money in, 4,000 a year that you can put in. So from April to April, you can put 4,000 in, and you will get 25% uplift to £1,000. So £5,000 a year that you'll get. Now there is rules and restrictions on it, so you have to be between 18 and 39 to open one, and then you can only contribute it up to a certain age, and then you can withdraw it from 60 at that point. And if you withdraw it sooner, you pay 25% tax charge on it, so you basically wipe out any of the bonus that you received. Now, that sounds good because you can access it unlike a pension. So it's a kind of halfway house, really, that you could get some tax relief, but not as much. Well, I say tax relief, it's more of a bonus with a lifetime ISA. But the flip side is the actual pension itself. The pension itself means that you can build it up over time. You've actually got a good amount of pension pot to utilize, but there's restrictions on it. There's no restrictions as far as if you wanted to take a lifetime ISA. But the problem being is if you did, you get charged on it. So if you really wanted your money and build up, it's a good way of doing it. Just be aware if you wanted to get the money, there's a penalty, whereas you physically can't really get the money out of a pension, just the way that the legislation is. So pension does trump a lifetime ISA, just if you were curious, which one would it do? So if you were to like put all the sum of the parts together, a pension does work out better. But if you're utilizing your full allowances for a pension, so you've maxed it out, then you could use this as a sort of your other one to get as much benefits as you can, or do them sort of side by side. You've also got cash. So if you did have, and I always say with, again, related to retirement planning, it's worth having a good amount of cash when you are at the point of retirement, because as pensions can vary up and down, if they were to drop, you don't really want to be selling units or selling some of your investments off when they're lower. In an ideal world, if they were to drop, you would then utilize a cash pot that you've got separately that you just manage yourself. And then when the stock market recovers again, that's when you then switch off the cash income and use your pension instead. But cash can be a tool. Like if you haven't got a pension pot and you think, well, I'm 2 years away from a state pension kicking in and I've had some inheritance or I've got some money, you could just use the money for a year or two. It's not really a long-term sustainable plan because the way inflation works and erodes the purchasing power. So you're just going to end up losing money quicker than you can make it. But if you're doing it for like a year or two, it can be something that you can, if you want to pull your retirement forward slightly, you could utilize that. The last one is if you're a business owner. So if you own a business and you've got an exit strategy for that business to sell, then there's certain quirks and things that you can do around selling business assets with certain very specialized reliefs that you can get actually as your kind of retirement and utilizing that instead of a pension. So if you've got a business that you're building up, and I've speak to lots of business owners and they always say like my pension is the business is my pension and my pension is my business. Like that's the way that they see things. Can be quite a good way of doing things. Obviously, there's a risks of that, and you're kind of putting all your eggs in one basket. So I always say if you can diversify a little bit and put a bit into a pension, it can balance it out. But it is another good potential option as well. So that is the main points that I wanted to cover off. I haven't covered everything off because there's only so much that I can fit in with about 45 minutes. But ultimately, I hope that's answered some of the basic questions. It may have even opened your ears and eyes to asking more questions about it, which is not necessarily a bad thing. But figuring out what is the best thing and kind of just understanding some of the basics can really change things for your retirement and just putting you back in the kind of driving seat. So they're the main areas that are covered off, and to sort of summarize the main points for you. And yeah, thanks for watching, and hopefully I'll catch you on the next one.